Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And when you look at the growth in the global economy since World War II in a dollar-based world, it's performed pretty darn well. So it gets poo-pooed a lot, and the reason it does make some sense because the U.S. government is abusing its world reserve currency responsibilities and the benefits it gets from it. But that can change. So we wouldn't write off the dollar, and we just don't see an alternative in the making.
Makes sense. I don't think you can answer this question, but I'm just going to ask it to you anyway. Alnur wants to know which currency options would you be buying in the short term? I know you've done all the ISE webinars. You're not a big advocate of trading that 5-day option or the 8-day option. What do you think is short, Jack, as far as options?
To us, a couple weeks is short. 2 to 3 weeks is short. That doesn't mean if we put an option on and we get an outsized type move the next day or 2 days later, we won't take it off and grab some gains. We absolutely will. But in general, our holding period for options is usually a couple weeks, up to several months, 4 or 5 months, even more, if something is moving our way or if something has moved away from us, and it only makes sense to hold it. So that's our sweet spot because, again, we have used the options as an event trade, meaning you can use the options and put them on and say, hey, the jobs number is going to be horrible on Friday. I'm going to play an option XYZ on an event trade, maybe something either in the money or at the money, something close in the expiration so you're not paying for the time, and use it as an event trade. We do that rarely because we don't have the ability to forecast how events will turn out. And so often, as you know, in the currency markets, you can get the news and the fundamentals right, but the currency goes the other way. So we're very careful with that, but you can use them that way on occasion. But in general, because you're buying yourself time with these options, we prefer to have both a technical view, but primarily a decent fundamental view, and we're buying ourselves time to let those fundamentals play out. And if at some point we can realize, hey, the reasons we made this trade based on these fundamentals set up are no longer in place, or we're wrong, we try and grab some premium. We try not to let them go to zero, meaning we try and grab some remaining premium. And that's, again, the beauty of these. 3 things can happen to you. You can make money on your trade. You can grab some premium when you realize you're wrong and put it towards your next idea, or you can lose your entire premium, but you cannot lose your entire account that you can lose in the spot and futures markets when you go long with a put or call, and that's a beautiful thing.
Well put. That's very well put, Jack. Question from Dick to me is, what kind of strategies are out there trading FX options, and really just about anything you'd like. So Jack likes to keep it simple, which I completely understand, buying a call or buying a put and taking advantage of that limited risk. But if you're interested in trading vertical spreads, full call spreads, bear put spreads, you can do that. You can trade calendars. That's a little more risky. I want you to understand that, Dick. And iron condors are out there. You can do that too. So whatever you feel comfortable with in trading an equity option, index option, you could do it here, trading ICFX option. What's the symbol for the dollar? It's going to SD is going to be based on whichever currency you're trading. So let me go. Let me show you all the currencies. Remember, Jack always says this is dollar relative. So you're going to be looking at one versus another. So the dollar against the Australian is AUX and so on. BPX, CDD. You can see them on your slide there. So I hope that helps. Let's get to a couple more questions before we call it a night. Oh, question about how much does it control? If you do the math, it's just 100 times that value. So if you're looking at the euro trading at 71, well, that's $7,100. If you're looking at the Japanese yen trading at 97 or wherever it is now, it's 9,700. Just multiply that ISE value by 100. Let's see. Patrick says, Jack, this is for you. Many gurus say that inflation will start to rise seriously in July. I guess that's what's happened over the last 4 to 6 weeks. What do you think? I think we know what you think. You really don't believe that all this inflationary expectations that it's really well founded, correct?
That's correct. We have an opposite view of what's going on. We're just watching what's going on in terms of the demand in the global economy, and we're watching the numbers. As I said, the CPI numbers are falling across Europe rapidly. They're falling into deflation. Japan's inflation, so there's two of the biggest economies in the world in deflation. The price numbers in China aren't ginning up despite their stimulus. Those numbers are starting to fall. In the U.S., when you look at the CPI, isn't exactly moving up in great shakes. And we think this goes to the idea that despite all the stimulus being thrown in the market, people aren't taking it. And you gotta have to take this money and run with it, and it has to show up in prices. Needless to say, this run up in commodities prices lately, a lot of people are screaming this is inflationary, but it's not necessarily, just because you have higher commodity prices, it could be supply and demand driven, may or may not roll into final goods prices, especially if China continues to believe that they can export their way out of this problem. What they will be doing is lowering prices continuously on their goods and exporting more and more goods and pushing down final goods prices. And unless we see a rebound in employment, a rebound in consumption, and a rebound in business investment, which we've seen none of those really across the major economies other than China in terms of business investment, we don't see an inflation problem in here. We don't see it, and we think the concern will be deflation, because if Europe goes into deflation, as we said, it intensifies that debt problem. And you can bet that's one of the reasons why all the governments around the world are throwing so much money in here. They know with the amount of leverage still in the system and the amount of toxic paper across the global economy, the deflation is a massive problem for them. So they're trying to inflate, but if consumers keep saving, we don't think it's going to happen anytime soon. That doesn't mean that if the economy doesn't gain some traction globally at some point in time, this overhang of money out there won't lead to an inflation problem. But at the moment, our risks are to the downside in terms of pricing. We agree with what Trishay said today.
Makes sense. Nigel has a question, and I think we may have even handled this the last webinar. One source quoted Russia as changing their reserve currency to the euro instead of the U.S. dollar. I know that you've commented on this many times. The euro debacle will therefore have a significant detriment that there are also, I presume, then. What's just this commentary or this talk that the Russians, I guess they're one of the primary countries, but also maybe the Chinese are saying that they want to move to some other currency. But the thing is, I don't know, are the Russians actually saying euro, Jack? I wasn't aware of that, but maybe they are.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.